Welcome to today's Daily Brief. We're diving into the two massive questions that are on pretty much every investor's mind right now. With all the fear swirling around, we've got to ask, is this the final washout we've been waiting for, or has the panic just gone way too far?
All right, let's get right into it. The big one, the question everyone's asking, especially if you're looking at Bitcoin and the wider market. Have we finally hit that point of maximum pain? That moment where everyone just throws in the towel, which, ironically, is often what it takes to find a real bottom.
Right now, the market has a total split personality. In the short term, things look, well, pretty bearish. There's a lot of fear, a lot of panic, and you can see it in the price action. But if you zoom out, the long-term bullish stories still seems to be there for a lot of people. And that conflict, that's what's creating so much uncertainty.
Okay, so to figure out if a bottom is even close, we've got to look at the charts. Let's break down the key technical support zones. These are basically the historical price levels where buyers might finally step in and say, all right, enough is enough. So the first major line in the sand is right around that 90,000 mark. And this isn't just some random number people are pulling out of a hat. It's a really significant trend line that has been on the radar for a long, long time.
And here's why this is so cool. That 90,000 level, it's not just a line. It actually connects the absolute tippy tops of the market from back in 2021. Think about that. What was once the ultimate ceiling, the highest the price could go, could now become a solid floor. That's a powerful idea in technical analysis. And right below that, we've got another critical zone of support. It's probably better to think of this less as a single price and more of a whole area, a strong zone where buyers have another chance to make a stand. This is just a textbook move. I mean, look at it. The 88,000 level was a ceiling for the price back in March, but it was a floor in January. Whenever you see a price level that has acted as both support and resistance, traders really pay attention. It basically turns this whole 88 to 90K area into a huge defense zone for the bulls. So you'd think, okay, the price is sitting in this super strong support zone. A bottom must be right around the corner, right? Well, maybe not. There seems to be one crucial piece of the puzzle that's still missing, and it's the one thing that suggests this whole decline might have one more painful drop to go. And that missing piece is true capitulation. Let's just be really clear about what that word means. It's not just the price going down. Capitulation is that moment when all hope is lost. It's when investors are selling in a full-blown panic, not because they want to, but because they just want the pain to stop. That's the kind of event that really cleans house.
And here's the issue. We're just not seeing that kind of panic. Actually, we're seeing the opposite. The data shows tons of traders are piling in with leverage, basically borrowed money, betting on a bounce. You can see it in what's called open interest. A lot of bets are still on the table. In fact, these buyers are so eager, they're actually paying a premium to the sellers. So when way too many people are trying to catch a falling knife, it's usually a sign that the real bottom isn't here yet. Yeah, so a healthy, sustainable bottom, it usually needs this kind of three-step process to play out. Right now, it feels like we're stuck in step one. The market often needs that final violent plunge down, some traders call it a whip, that forces all those leveraged buyers to sell. That huge wave of forced selling is the washout that finally lets a real floor form. So let's zoom out a little bit to the macro picture, because none of this is happening in a vacuum. This entire downturn was kicked off by a pretty significant and frankly deliberate squeeze on liquidity in the whole financial system. Okay, so part one of this squeeze comes from the US Treasury. They've effectively pulled $650 billion out of the banking system. And it's pretty simple. Less money floating around in the system means less money available for riskier things like stocks and crypto. And it's a real one-two punch, because at the exact same time, the Federal Reserve is doing its own thing, continuing its quantitative tightening policy, which also pulls even more money out of the system. It's been this coordinated drain on liquidity, and it's put a ton of pressure on the markets. So we know this liquidity crunch was planned. The powers that be wanted to tighten things up. But the really big question now is, has the market's fear just gone too far? Is this whole thing an overreaction? To answer that, we can actually look at the plumbing of the financial system itself. This indicator here, it measures stress in the overnight lending market between banks. And what's amazing is, despite all the panic we're seeing on our screens, this number shows that stress in the core banking system is actually low. In fact, it looks like tensions are already easing up. The worst might be behind us. And when we look at other risk indicators, we see the exact same story playing out everywhere. Sure, the premium investors want to hold risky bonds has gone up, but it's nowhere near the panic highs we saw back in April. The stock market's fear gauge, the VIX, it's up, but it's also still below those previous peaks. So when you put all this data together, a really clear picture starts to form. The fear that you see in the headlines, it seems to be disconnected from the actual systemic risk. The data is pretty strongly suggesting that the market's reaction is just, well, bigger than the actual problem. So where does that leave us? We've got a market that's stuck. It's caught between really strong technical support on one side and a lack of that true capitulation on the other, all while the big picture data suggests this is an overreaction. Well, there are two huge events coming up this week that could finally break this deadlock. First up, all eyes are going to be on NVIDIA's earnings report this Wednesday. As a bellwether for the entire tech sector, a strong report could give a huge boost to all risk assets. And then, of course, there's the Fed. Their next decision on interest rates could either pour fuel on the fire or give the market a major green light.
And this slide just perfectly sums up how uncertain everything is. The prediction markets are pricing the Fed's next move as basically a coin toss. It's almost exactly 50-50. And when the market has this little certainty about something so important, one thing is pretty much guaranteed. We're in for some volatility.
And that really brings us to our final thought. We are in this fascinating standoff. On one side, you've got all this short-term fear and what feels like the need for one last capitulation. And on the other side, you've got all this macro data that suggests we're just overreacting. With NVIDIA and the Fed coming up, the next few days could very well decide which side was right all along.